Good evening, everybody, and welcome to our webinar this evening. Tonight we've got a special guest talking about SSAS pensions in the form of Gareth Alexander. So I'm just going to get this moving over. So welcome back to anybody that's come to a Fabric webinar before. My name is Matt Hopper-Penman, one of the group directors here for those that haven't been on one of our webinars before. And obviously a big welcome to any new faces as well joining. So tonight, like I say, we are going to be looking into the world of pensions and how you can use your pension to invest into property. So I'm going to hand it over to Gareth, who's going to take you through that. And then later on, I'm going to then show you some examples of some deals that would work in a pension environment. Over to you, Gareth.
Well, thank you very much, Matt, and thank you, Lynn, as well. I know you're hiding away at the moment, so no one can see you, but I'd like to thank you both for organising tonight and inviting me along. So I'm going to talk about the exciting world of pensions. But the truth be known, when we say the word pension, we think of your grandma or your granddad getting old, and we don't think about it in the right context. So I'm going to try and talk about it tonight from a different perspective, and why a pension should be considered as an absolute essential tool, especially a SSAS pension, from a business owner or a company director's point of view. Next slide, please, Matt. So first, let me talk about empowered pensions and myself. So you've probably heard of empowered pensions. As a SSAS provider, they've been around for over a century. Sorry, over a decade, not over a century, over a decade. Over the last probably 18 months, 2 years, it's sort of transitions, transformed. So we refer to ourselves now as sort of the empowered group, because within that we have various elements or subgroups within the overall group. And the reason we've done that is because, and as I'll discuss it as we go through it today, having a SSAS pension is one thing, but how you integrate it and use it with everything else is absolutely essential. So I'm the director and co-founder of Grow Empowered, and Grow Empowered, think of it as like the customer front end, the strategy, the support, the services, from not just from a SSAS point of view, but from a holistic point of view. Then we have Empowered Pensions, where your pensions are administrated from. Then we have other subdivisions like Empowered Funding. It's about to be renamed to being Evolved Lending shortly, but what that is to help our clients who want additional funding around projects, deals, and how we, as a SSAS trustee, can lend you funds as well. We have Empowered Advisory. That's a new area of the business where we're going to start to give regulated advice. And then we have Empowered Wealth, which is this unique tool, this unique system that we have that allows you to understand what investments are available, allowable, how you can do it, how you can understand where your value of your pension is, all the unique information. We are transitioning the business now to, first, we're fundamentally a SSAS provider, but it's about all the other elements that come together to make sure you can utilize your SSAS and everything around it to maximize it for your goals, your objectives, your ambitions. Next slide, please, Matt. So a little bit of a legal disclaimer. A SSAS pension is not regulated, so we're not going to give anything we discuss tonight is not a guidance. It's not advice. It is just about education and knowledge about SSAS pensions and the things you can do with it. And as I recommend to anybody, if you're going to start going down the pensions route, especially if it's about transferring pensions, you should always take independent advice where you think it's beneficial and talk to professionals in that industry. Next slide, please, Matt. Right, so let's get into it. What is a SSAS pension and how is it different? Well, a SSAS pension is really no different to a pension that is owned by BP, British Airways, Siemens, all the large corporate companies, because the SSAS pension is a company pension. It's an occupational pension scheme. Next slide, please, Matt. But one of the key differences of this is you are the trustees of that pension scheme, just like a large corporate scheme, like a BP, like I said, like a British Airways. So, but you are the trustees of that. So you are in charge of how those investments are implemented, decided, the strategy, the direction of that SSAS pension. It's for you to decide as the SSAS trustee. But one of the key differences between a large corporate pension and a SSAS pension is that a SSAS pension can only have up to 11 members per scheme. So sometimes you'll hear it referred to as a family investment pension or a family wealth scheme. because traditionally that's what they're about. They're about where it's being used as a family wealth vehicle. So you can add your children to it, you can your spouse, you can have anyone you like in it, but the maximum number is 11. Maximum number of trustees is 11 people. But more importantly, as I said before, even though we call it a pension, it's a tax-free trust. Everything within there currently is completely tax-free. Now, the rules are going to change slightly on inheritance tax in 2027, and I'll touch on that slightly as we go through this. But it's an absolute tax-free trust. So any growth you have in there is completely tax-free and protected. And then there's other things you can do with it as well that I'll talk about that's quite unique to a SSAS pension. But fundamentally, your SSAS pension becomes your own investment bank. You decide how you invest that money. You decide how you put it into different areas, and we'll talk about that in detail. But it's really good to think about it as not a pension scheme, but as a tax-free trust and as an investment bank. Next slide, please. And the way I always sort of like visualize, I'm a visual person, is I always think, if imagine you're walking down Bond Street or Oxford Street in London, and you see these magnificent buildings to the left and to the right of you, going 2, 3, 4 stories high. Those buildings are hundreds of years old. More than likely, all of them are probably held within a trust. And that SSAS pension is a trust. So you'll probably find a lot of them are owned because they're commercial or because the way they've been structured are probably held in trusts. Buckingham Palace is held in a trust. Most of the properties down Mayfair and Hyde Park are held in trusts. You, as a SSAS pension trustee, have that same ability as what everybody else does. And SSAS pensions have been around for 50 plus years. Trusts have been around since the Crusades. So it's this well-trodden, well-used vehicle that now you has access to as an everyday person. But now you get the ability to use it in the same way as what the wealthy have used for many hundreds of years. Next slide, please. So let's talk about your SSAS as a bank. So let's look at it slightly different. So instead of it, excuse me. So instead of it being a pension, we're going to talk about it as a bank. And there's 4 fundamental areas that I think of when I think of a SSAS pension or an investment bank or a trust. Next slide, please, Matt. So one of the key things straight away is the pension contributions. So like in any pension, you will contribute to a pension, and because in the future you want to build a nest egg to retire on. But your SSAS pension is done slightly different than that. Again, it's same as any other like pension, as in a SIP or a individual pension or a corporate pension, but you've got slightly different ways of looking at it. So anybody, any member of your SSAS pension can contribute up to £60,000 per year to their pension scheme. That's the same in any pension. And you can also do what's known as a carry forward. So let's just say you've not used 2 of your previous 3 years' pensions allowances. You can actually carry that forward by adding that in from the previous 3 years. So £60,000 a year. The rules changed slightly a couple of years ago, but for today's webinar, let's say it was £60,000 for the past 3 years. That's £180,000. If you've not used any of that in the past 3 years and your business has had an absolutely fantastic year, you could use a lot of those contributions in a lot of that profit in your SSAS and setting the structure in a certain way to pay for any unused contributions in the past to lower your corporation tax and reduce your tax. Because you can pay your contributions directly from your limited company that's connected to your SSAS pension. So again, when we look at the bigger picture, it's not just a case of you contributing to your SSAS, it's how do you contribute it from your limited companies to try and manage your taxation methods that you have in your tax. I'm not against paying tax. I just want to pay it in the best possible way so I can utilize that money to reinvest it elsewhere. So again, your SSAS pension is a fantastic tax vehicle. Next slide, please. And again, one of the key things of your SSAS pension is you can actually pool your contributions together. So let me give an example. Let's just say you've got 4 members in a SSAS, and they could be related or they might not be related, but let's just say you've got 4 trustees within a SSAS. One person could put in £30,000 a year, one person could put £20,000 in a year, another 15, and another 60. But altogether, in that 1 year, from them 4 different people of different values, you've pulled £125,000 into your SSAS. So now you can use that £125,000 to invest in whatever you see fit within the rules of HMRC to invest. So you might now buy a property that's worth £110,000. and you've pulled all your investments together, that rent then would collect back into your SSAS, all tax-free, and it would grow. And then when you come to retire, your retirement drawdown is based on individuals' inputs into the SSAS. We call that earmarking. So it's managed in different ways, but it's a great way of pooling your funds together, hence why it's known as a family wealth vehicle, because integrating that with your businesses and your family, you can start to create a lot of compound wealth very quickly within your SSAS pension. Next slide, please. And some other unique features of your SSAS pension as well. So you can do what's generally known as a GUF payment, a general unallocated fund. If you have 2 or more members in your SSAS, you can put in up to £500,000 into your SSAS pension. And that £500,000 could be for future contributions. It could be to pay for future contributions for your trustees, like you would in any other normal pension scheme. So what the government actually allow you to do is, let's just say you've had a portfolio in your limited company and you've decided for whatever reason to sell that portfolio, and you've made some good profit over those years, and you've got £500,000 of profit. Or you could even be selling a business. You could be doing anything, but let's just say you've got £500,000 of profit that's in that limited company. Now, you could get taxed on it, or you could just do a GUF contribution from your limited company to your pension. And then once it's in your pension, you could then loan that money back to your limited company to buy other assets, to do other investments. So it becomes a very circular process to keep help building your SSAS. Now, I'm giving you a very top level viewpoint here, and there's always the devil's always in the detail. But if you can imagine, you taking the money from your limited company, putting it into your SSAS pension, and then loaning it back to your limited company or another limited company that you've connected to your SSAS pension to invest in more property, to invest in other areas. And it continuously grows. So that's why I always like to think of it as an investment bank, because you're the investment manager along with your other trustees to determine where that money goes and what you want to do with it. So it's a really flexible tool. And part of what we do at Empowered, it's not just giving you a SSAS pension, it's sort of like giving you some insight and guidance about the other ways you can use it and utilize it. Because we're all on this unique journey. We all want to do it slightly different, but it's really essential to understand what you can do with the SSAS. Not because that's what you're going to do, it's just that you'd like to know what you can and can't do with it, and that helps set your strategy and your guidance and your planning, any direction of travel. Next slide, please, Matt. So, excuse me. So, and just to sort of halfway through the presentation, what I'm going to say as well is we can ask questions at the end if anyone's got any questions. So I'm going to go a little bit more devil in the detail now. I'll talk a little bit more about what you can do and sort of the investments you can have. So you can invest in a wide scope of things directly with your SSAS funds. So once that money is in your SSAS, and that money can be in there from contributions from your limited company, you could have transferred existing pensions that you have into your SSAS pension. There's all different things you can do. But once that money is in your SSAS pension, your SSAS can invest in it in various different ways. So let's go from left to right. So your SSAS can invest in commercial property, and it can't invest directly in residential, but it can invest in commercial. And it's based on the classification usually of what that property is, but anything commercial can typically be held by your SSAS. And on top of that, you can also hold certain service accommodation if it's under a C1 classification. You could also have certain supported living as well if there's certain the correct leases are in place. Our job at Empowered is to have that conversation with you to make sure that before you commit to anything, we understand whether it's allowable or not. But you can hold quite a wide different spectrum of types of commercial property within your SSAS. You can buy land with your SSAS. Now, a good example, you might buy land with your SSAS, you might buy some land, your SSAS then may take it forward to planning and get planning permission to convert it into 4 houses. And then actually your SSAS can even pay for some of the development of that house, some of the build of it. As long as it doesn't own it, when it is classed as residential, then you're okay. Because what you could do, you could structure the deal in such a way that your SSAS pays for a lot, the land, develops it, and then even you could do then a loan back from your SSAS, assuming you had enough funding in it, to your limited company to buy that property or that land from your SSAS. And there's so many different things you can do to generate income both within your SSAS and outside of your SSAS. You can invest into crypto, or a wide range of different digital currencies, tokenization. You could do all sorts. You can buy stocks and shares. You can invest in FX. You can do options trading. You can do angel investments into startup businesses. You can buy shares in new businesses. You can buy shares in your own business. You can do third-party loans, peer-to-peer. There's such a wide scope of things you can do with your SSAS pension. This is why it's really important to have a strategy and a plan about what you want to do and why. So you should always start with the end in mind to understand how you can get there, because there's so many different things you can do. I look back on my own journey and think if I had taken just a little bit more time to think about what I want to do and why, I'd have been to the position where I want it to be quicker, rather than going head first into some investments. So it's really having that plan in place to understand how you can get there and why. Next slide, please, Matt. So I'm going to talk about now third-party loans. Sometimes hear them called developers loans, but the sort of main term we use is third-party loans. This is where we, as a SSAS trustee, decide to lend money to an unconnected party. And what we mean by an unconnected party is I'm not connected to you by blood, so I'm not related to you by marriage or next of kin or anything like that, and I'm not connected to you by business. And what we mean by connected by business is I'm not connected with you on Companies House as a co-director of another business. So that's what we typically mean by an unconnected party. But once we've got that, and I know that, and as far when I look on the list of who's on here tonight and talking to Matt, I don't believe I'm connected by blood or by a business with anybody here tonight. So I could decide I want to lend my money to any of you guys and girls here tonight for a property investment deal or for some type of business investment. Now, I set the interest rates. I determine what interest rate I'm going to get. It's got to be commercially viable, but I determine the interest rate, and I determine the terms and conditions of the loan agreement, and I determine what security I want on that as well. Now, within the HMRC manual, you can actually just use a personal guarantee. We would never, ever sort of recommend that. You should always, at the very least, get some type of second charge, but really, mainly, you want a first charge security on any money that you're lending, because when things go wrong, you want to make sure you can get it back. But ultimately, you're in a position to lend money to who you see fit. So you've got to do the due diligence. You've got to understand the risks. You've got to understand the capacity for loss. But again, it's a powerful tool because you can then decide to lend that money to people to make it grow and then return it. And people do that on a regular basis. Next slide, please, Matt. And one of the things that's very unique to a SSAS is a SSAS loan back. This is where you lend money to yourself. But really what we mean by that is you lend money to one of your connected limited companies. So when you start a SSAS pension, you always start it with a sponsoring company. That's the main company that is used when we do the application to HMRC on your behalf. We say we're setting up a company pension and an occupational pension for this company here, for this sponsoring company. So once that's set up and approved, that's fantastic. We're great, good to go. But then we can add other companies, other limited companies to your SSAS by a deed of adherence. And that could be a brand new company that you've set up today for an SPV. So there's different things you can do, but you can now lend money from your SSAS to those limited companies, to your limited companies. Now, there's a couple of caveats. You can't lend more than 50% of your net value of your pension. So let's just say your pension is worth £200,000 net value. The maximum you can loan to your limited company is £100,000, so 50% net. It's got to be at least 1% above the base rate. So right now we're at what, 5.25%. It might be below than that now, but it's got to be 1% above the base rate. It can be no more. It can be the term of the loan can be no more than 5 years, and you must repay that loan over equal amounts over that 5-year period, including the interest. So let's just say you borrowed £100,000 at 10%. You would have to pay £20,000 a year back each year over a 5-year period, plus the interest each year. So 10% of £100,000 is £10,000. So you'd be paying 20%, £20,000 capital and £10,000 interest each year. But most people use it as an alternative to bridging loans because it's such a powerful tool. You can have your loan back set up and ready to go easily within 30 working days, 30 calendar days, I should say. It's a very quick tool. And that money can be used for various range of things. You could lend it to your limited company to buy commercial property. You could buy it, split it out, and create more revenue. You could buy a residential property at auction, flip it, sell it. You could put it to your another company that you have to create working capital. You've got to provide security for that loan of at least a first ranking charge, and that can be the asset you're buying. It could be a debenture over your business. It could be an unencumbered asset. It could be shares in a business. But it's got to be at least the equivalent of first ranking charge. But once that's in place, you have this, back to this thing about the investment bank. You have this tool that you can keep lending money to yourself. So you're almost, in fact, you are a cash buyer. It's a really powerful tool and very unique to SSAS pensions. Next slide, please, Matt. So let me give you a bit of an example of how that would work. So let's just say on the left-hand side here, you've got your SSAS bank, your investment bank. So again, let's not call it a pension, let's call it a bank, an investment bank. You then lend money to your limited company. And in this example, we're going to lend it to buy a residential property in your limited company. And then what you're going to do is, let's just say, again, for simple maths, you buy a residential property for £100,000, you spend £20,000 doing it up, and you sell it for 150 after you've paid and you've done that all within 12 months. Let's just say you've repaid your SSAS loan back, you've paid the interest, and there's £20,000 profit left. That £20,000 profit could be your income, it could be your salary, it could be profit within the business. Next slide, please, Matt. But what would happen there? Let's just say you don't need that to be paid a salary, or you've actually made more money than you anticipated. You could have £20,000 profit sat in your limited company. So instead of you paying your corporation tax on that £20,000 profit, what you could do is just simply make a pension contribution, because as I said earlier, you could make up to £60,000 per year per person. But let's just say that profit is then taken out of that limited company, and then you make it as a pension contribution back to your SSAS. You've then reduced your corporation tax in your limited company, but you've also increased the value of your pension. So thus you've increased the value you can lend in the future because your pension has increased. So you've got this vehicle that allows you to, done in the right way, make money. You can either make money within a limited company, you can pay yourself an income, you can pay a salary, but also when your profits are doing very well, you can then make contributions from that limited company back into your SSAS. So again, even though we call it a pension, think of it as an investment bank. Think of it as this great tool you've been given that enables you to utilize your funds on your terms, on how you want to invest that money. Next slide, please, Matt. And I'm just going to quickly go show a little bit of an example here about how when you start to get a little bit more devil in the detail about how you can use a SSAS pension. So, and I've used round numbers because you've probably guessed tonight I'm a simple guy, so I like to use simple figures. Let's just say your SSAS buys £100,000 commercial property. So that example I gave earlier, where you had those 4 people in a SSAS and they all contributed together for £125,000. Let's just say they go off and buy this £100,000 commercial property directly into their SSAS. And it's not that registered, it's completely tax-free. It's a great buy. Next slide, please, Matt. Now, what we're doing, we're going to create an OpCo-PropCo setup here where you're now going to create a limited company, a brand new one, that's going to lease that commercial property from your SSAS pension. Let's say it's going to lease it for £1,000 a month. But this limited company that you've created outside your OpCo company, that is now going to take that commercial property, split it down into 6-7 units, and rent them out independently, almost like a storage facility. So next slide, please. So let's say, for example, that OpCo makes, because it's split it down and it's doing it as a storage facility, is now making £5,000 a month. Again, using it as an example of simple maths. So your SSAS pension owns that commercial property. It's now leasing it to your limited company for £1,000 a month. So it's getting a 12% yield on that investment. But your OpCo company is now making £5,000 a month because it's renting those units out, those storage units out to a wider scope of clientele. So they've increased the revenue. Next slide, please, Matt. And let's just imagine of that £50,000, you've made 60,000. That's £5,000 a month. You've made £60,000 in the year, and let's just say you've made 20% profit. So that OpCo has made £12,000 profit. Again, I'm just using it as an example. So you've bought a £100,000 property in your pension. You've rented it to your limited company. So there's rent going between them two. Your limited company is now renting out to 6, 7, 8 other businesses and creating a higher yield or a higher income, and it's also made a profit. Next slide, please. And what could happen again, that £12,000 profit, you could pay corporation tax based on that £12,000, or you could simply just take that £12,000 profit that you had and put it into your pension as a pension contribution. Again, reducing your corporation tax to virtually zero. Again, depending on how you want it to tweak it. But that's just a really simple model to explain how it could work. Next slide, please, Matt. So just using that real simple model, that would grow your SSAS pension by £24,000 a year tax-free. So that initial £100,000 investment has created you a 24% return on that model that you've created. And how have you got to that £24,000? It's that £12,000 a year rent that your limited company is paying your SSAS for the use of that commercial unit, and then the £12,000 profit your limited company's made because it's been managed quite well, making profits. So again, the example, you're making £24,000 a year, reducing your corporation tax, but you're building and growing this business. You could potentially exit in 5 years' time, and going back to what I mentioned earlier about if you sell your business, you have that GOV payment that you could put into your SSAS pension again to reduce your taxation. So using this real simple approach, this real simple business model, over 5 years, your pension would increase by £120,000, as in the sort of the values, and the asset would increase in value, and the business would increase in value. So again, I always talk about having a SSAS as a marathon, not a sprint. So just using this similar model. Again, you've got to find the right properties, the right location, have the right structure in place. But again, you've got this one unit this one investment that you've had, that if you start to extrapolate more and more cash out of, and your SSAS pension is there to really make it all come together in that tax-free environment. Next slide, please. So again, really what I'm trying to explain is having a SSAS pension on its own is good, but you've got to think how you wrap it around with everything. So the example I always give the visual is you could have the best Formula One car in the world, but if you haven't got the right driver, the right team around it, the right pit crew, the right strategy team, then you're not getting the maximum benefit out of it. And that is the same with the SSAS pension. It's how you put all these other things around it, connect it and integrate it together to maximize everything that you need. Next slide, please. And that's really what I talk about when we talk about growing empowered in the empowered group. It's really our role is to give you that guidance, insight, and support about what you can do with your pension. But we always talk about what is your end goal, start with the end in mind, and how you can integrate it into everything that you want to do. And provide, and we want to provide that training, that knowledge, that community aspect to help you build and sustain that family wealth, because things will change. It will all we're in this world where things will always change. Next slide, please. And I think it's probably over the last, since June, July of last year, we've already realised that things are changing a lot. And I'm using this current government as an example, but we've already seen there's a lot of changes happening in the tax pension world, in the investment world. We're all business owners in the business world. So having a SSAS, being able to implement it with all your other businesses and your activities really gives you that upper hand to be able to be agile to meet any changes that are coming along. And again, working with us at Empowered, it's about the community, it's about education, it's the knowledge about if things change, what do we need to address, what are the opportunities? Next slide, please. Now, I absolutely appreciate I've probably talked for a full 30 minutes at breakneck speed, and I've probably, there's a hell of a lot to take in, and I've probably made some confusions, and I'm speaking with my wonderful Hull accent, which probably doesn't make it easy for a lot of people. So what I would say is I've put a QR code on here, and you get a download if you complete the form and submit it to a wise SSAS document. Just provides a lot more detail about what a SSAS is, how it works, what you can do with it, the pros, the cons, the risks, the rewards. We're very open about a SSAS pension. It's not for everybody. It's got to be for a certain amount of people who want to utilize it in the right way. And it has information there about tax and tax planning and the costs and everything. So there's a link in there, and also you can have schedule a one-to-one call, either myself or one of my colleagues, where we happily talk you about the pros and cons of having a SSAS pension. Now, Matt, back over to you. Have I covered everything off, and did it make sense?
Brilliant. Thanks, Gareth. No, I think everyone will agree that was super valuable. I think, the amount of people that we speak to in property that still don't know what a SSAS is, it's never ceased to amaze me. So it's a really good opportunity to leverage funds that you probably didn't know you had access to then, get control of and start investing yourself. So thanks very much. I'm sure there's going to be a lot of questions when we get to the Q&A, but before we get there, guys, what we're going to do is I'm going to take you through 3 deals that would qualify under HMRC guidelines for allowed to be invested into your SSAS. So we'll kick off first of all with this one. This is a bar. It's a public house, a modern cocktail bar and restaurant, Slug and Lettuce, which is actually directly leased by Stonegate Group, which is the largest pub company in the UK. They've got a 440 million EBITDA. So just a little about this deal. The price is £850,000 and it's let on an £80,000 a year income until 2037. So there's still 12 years remaining on the lease. And that, with all the yield, with all the closing costs and operational costs, is a net yield of just over 9%. I'll show you the actual figures in a second of how we get to that. But the good thing is you can buy this directly into your SSAS. It's a purely commercial real estate deal. So the SSAS can buy it itself, either buy it cash or you could use lending to do it. This property is actually in Blackpool. So if you can see my cursor, this is where the property is. It's quite close to the Blackpool North train station. And if you've been following Fabric at all, you'll know that we've had a heavy presence in Blackpool for the last 10 years. We've done a lot of deals in and around the town. There's about 2 billion of regeneration that's ongoing about Blackpool. And I could probably cover Blackpool in a whole 2-hour presentation. So I'm not going to bore you too much of it today. But yeah, it's right in the town centre, this opportunity. This is the inside. So it was actually recently renovated. About £400,000 was spent on the renovation. So that gives you very good indication of the tenant's intention in terms of their longevity in the property. But as you agree, you probably see there, nicely done. You can see even to the toilets has been done pretty well as well. And here's the financials. So any opportunity that we share with our clients will get a financial breakdown like this. So the actual internal of the property is very big. It's 5,500 square feet. 850,000 is the price. You've got stamp duty, which is non-residential stamp duty, of course. So as of today's date, that's £32,000. We've got in there at legals at £6,000. That's about 5k plus VAT. Again, estimated. There may be a saving to be made there, but all in all, £88,000, sorry, is the cash required to do the deal. And then on the actual rental side, the lease, FRI lease, fully repairing, insuring lease, which effectively means that the tenant takes care of all the repairs, maintenance, utilities, everything to do with that property, including service charge as well. £80,000 on a monthly basis is 6,666, as we can see here. And there's no costs of the lease. Effectively, all of the cost service charges recharged to the tenant. So that effectively is your net yield as well, net income, which, as you'll see over here, is the 9%. That takes into account all of your cost, 888, against your net income to give you a 9% yield. Okay. We also have a look at the 5-year projected investment scenario. So market value of the property is 9% against the 80,000, which is 880. So you're buying it 30,000 below market value at 850, as you see there. And then you've got your closing costs to take into account, which is just your stamp duty and legals. And then you've got a 5-year rental scenario and your capital uplift, which we've used Savills projection there. So you're looking at £658,000 over a 5-year period projected, which works out to an annual 15% ROI effectively. So that's the Queen Street pub deal. Again, any questions on that, please feel free to put it in the chat and we'll answer that at the end. So that was that deal. Now, number 2. So this one is also in Blackpool as well, but you might have noted when Gareth was talking earlier, he was talking about C1 use class and restricted use class. So this is a holiday apartment, short let apartments with restricted use class of C1. Now, C1 is hotel and holiday effectively. So this can't be used as residential. Now, it's important to note different SSAS trustees see this slightly differently. However, we've spoken into Empowered, and this would be something that would pass for them. Now, in terms of what we're looking at here, you've got 6 one-bedroom short-let apartments on 1 freehold title. Again, like I say, restricted to C1. The price is £330,000 with a net income of £31,000, sorry. And that is a net yield of just over 9%, again, including the closing costs. This particular one is actually let to a local operator who is operating Airbnb and Booking.com on a 5-year fully repair and insuring lease. Again, super hands-off, you know, in terms of the operator's going to take care of all of the upkeep, utilities, repairs, and all that kind of stuff. And again, with this one, you can buy it directly into your SSAS pension. So here's some photos of the internals that you can see here. So this is the property. And here is the financials for this one. So 330 is the price. Stamp duty on a non-resi rate, again being commercial, is £6,000, with legal fees in here at £3,000 plus the VAT, which gives you just under £340,000 as your total cash required. The actual rental here is 2,583, which is just 31,000 on a monthly basis. We've then got some building insurance to actually take care of in this one. So everything is recharged to the tenant except the building insurance in this particular deal. So you've got a small expenditure there, which means that your net income is just over 2,500. And that would take you to 30,640 as your net income and 9.02% in terms of your net yield. If we take a quick look at the 5-year investment scenario again, you've got 330 as your market value. You've got to take away your closing costs, which is just your stamp duty and your legal fees. You've then got a 5-year rental. On this particular deal, it's a brand new fully repair and insuring lease. There is a 2-month rent-free period, so we've deducted 2 months of rent out of the 5 years there. And we've also got a projected capital uplift, which has been provided by Savills again as of 2025. So we're looking at 94,000 growth in the next 5 years. Again, I will reiterate that is a projection. Nobody has a crystal ball. If I had that crystal ball, I think, you know, we could all retire and put our feet up. But yeah, it gives us a good steer of where things are going to be. And then that means that we're looking at return on investment over a 5-year period of about 68% and a 14% all unlevered and a cash purchase. So that's the second example. And again, these deals are available. So if you'd like to speak to us about these deals afterwards, then we'll give you an opportunity to do that. And then the last one that I wanted to share with you guys is the Queen Street investment. So this one is a commercial with 2 times short-let apartments restricted to C1 use on a 5-year FRA lease. Very similar to actually a bit of a mixture between the first deal and the second deal, with having a mixed use scenario in place. Now, this one is priced at £450,000 with a projected net income of 41,882. Again, you'll see that they're coming around about the 9% net yield mark. The commercial units on a 5-year FRA lease, similar to the second deal. However, the apartments are on a live yield managed basis, and you can buy this directly into your SSAS. Again, SSAS trustee dependent again. So here's some internal photos of the outside and some of the internals. So this was converted, I think it was converted last year from a conversion into C1 apartments, as you can see here. Some photos. We've got full information packs on all of these deals, so I'll give you an opportunity later on to request those. So in this particular example, we've got a price here at £450,000. Stamp duty here is £12,000, and you've got legal fees, and again, similarly at 3,600. So that means your total cash on this deal is 465,600. In this particular one, because there's 2 types of actual unit, you've got a commercial unit and you've got apartments, we've separated the 2. So the commercial unit is on a 5-year FRI lease, which is at £9,000 a year, so $750 a month. And then you've got your SA apartments, the service accommodation apartments, netting you an average of 5,000. Now, what I would suggest on this one is, look, you know, it's going to have a bit of variation throughout the year. This is an average figure. So you might be a little bit more quieter in January, February, and you'll be very busy in August and July, for example. So this is an average figure throughout the 12 months. We've then got here some management for your commercial unit at 10% plus the VAT. And then we've put in here about 45% for your costs of your apartment income to get you to your net yield for the actual property. So that takes you to the 4188 I mentioned earlier. Again, a 9% net yield. If I just take you quickly through the 5-year investment scenario, we're looking at £450,000 for the market value. Closing costs, stamp duty and legals are in there. You've got your 5 years of rental income and your growth again from Savills, which gives you a 70% over 5 years and then 14% annualized effectively. So hopefully that gives you a good example of, some of the uses you can use your SSAS for. If you'd like to talk to us about these deals again, we'll give you a chance to put that in the chat. So now's an opportunity for you to put some questions in the chat. I've seen, loads coming through already. To either ask Gareth, I'm sure there's gonna be a lot more for Gareth than myself, but for Gareth, or if you want to ask me a question about one of the deals I just shown, please feel free to put that question into the chat now, and then we'll take an opportunity to answer those. I'll also, at the end, like I say, give you an opportunity to ask for the deals and also some documents from Gareth. But let's look at some questions. So the first one I can see here looks like it's directed to you, Gareth, is for people with PAYE jobs, can you pay money into SSAS on top of pension money paid into pension from your employer?
Great question. And the answer is yes. So a couple of key things here. So when you're in employment and you're paying into their pension, you are getting tax relief on doing that as well. So as I mentioned earlier, the maximum amount you can put in a year to your pension is £60,000 a year. So let's just say you're an employee, PAYE with another company, and they're putting £20,000 a year into your pension, and you're getting the tax benefits of that, of the 20%, and then you're seeing that in your wages. That's fantastic. So you're putting £20,000 a year into that pension, because you can have as many pensions as you like. There's no restrictions to the number of pensions that you can have. So you can put that there. Then you've still got £40,000 headroom, should we call it? So you might have a limited company over here that's doing property investments or other type of investments, and you may then contribute from that pension, from that limited company, into your SSAS pension. And let's just say you contribute another £20,000. So throughout the year, you're putting £40,000 into both your pensions. You've got to make sure you talk to your accountant, because you'll have to do self-assessments and other things. But in essence, there's nothing wrong with computing to several different pensions at the same time. It's what suits your unique situation. So great question. Hope that answers it.
Thanks, Gareth. So the next question I've got here, I think it's for you again. So what happens to a SSAS pension upon retirement or death? Can SSAS funds be passed on tax-free to beneficiaries?
So another good question. So let's talk about retirement first. Right. So when you retire, your SSAS pension remains operational. It's just like any other pension. So when you retire, you are going to draw down. So let's take an example of maybe two trustees. One may decide to retire earlier, or maybe at the right stage in life to retire. The other trustee may be a little bit younger, so isn't quite ready to retire. So you will just, when you get ready to retire, you just need to make sure you've got sufficient liquid cash within that pension. So let's just say you've got an asset, commercial property that's creating £3,000 a month rent. You might decide to take £1,500 a month as a pension drawdown. And so you just need to make sure you've got enough liquid cash to pay for your drawdown for your retirement. So you can do that. You can take a lump sum. You could take up to, depending on how much money you've contributed to your pension, you could take over £268,000 as a tax-free lump sum from your SSAS pension. There's so many different things you could do, but once you draw down on it and start to crystallize it, your SSAS pension still remains, because, as I mentioned earlier, you might be one of 11 other trustees. So you might have retired, but the 10 other ones may continue to contribute, may continue to utilize it. So yeah, it just carries on going. Now, two things certain in life: we pay tax and we die, and we don't like either of them, do we? Let's be realistic. So when you die, because unless someone's told me otherwise, and I don't like the film Highlander, unless we will all die at some stage, when you die, currently your pension is just transferred over to your next of kin. and or other family members, or depending whatever you've done with it, or whatever you stipulated in your letter of wishes, your estate plan, in your will. So right now, everything in your pension is completely tax-free. I mentioned before about being in a trust, everything around it, so it's completely tax-free. The Labour government at the last budget in October, actually what they've said is that as from April 2027, they want to introduce your pension into your overall estate. So potentially, what money you have in your SSAS pension will be part of your overall estate. But we foresee there's lots of twists and turns to happen yet, because there's certain issues that'll create if they do that. Plus, there may be other methods as well to manage that, but we're still quite early in that process. As I said, it doesn't change until April 2027. And I suspect, just if you just look at the news every day, there's always a lot of changes, so things could happen. But if that is the case, there's other methods to sort of mitigate that. But again, back to my initial point, is your SSAS pension gives you this great flexibility, the ability to be agile, so you're in a good position to sort of manage whatever situation may happen. Okay.
Thanks, Gareth. So the next question I can see here is, hi Matt, with your FRI investments, any rental increases over the term? So yes, in answer to that, normally with any FRI investment that we work on, usually there is a rent review period. If it's a 5-year FRI lease, usually it'll be on the 3rd anniversary, but they all do differ, but most will include that, and we'll be negotiating that on your behalf. So to answer your question, yes, there is. Next question I can see here is, how long do I have to work in the UK to be able to get a SSAS pension? I guess this one for you, Gareth.
Well, so this is another good question. So technically, you don't have to work in the UK. So your SSAS pension, so one of your first requirements for setting it up, you must be the director of a UK-based company, and you must pay some type of UK-based tax. But you could be living overseas, you could be working overseas, you could be a non-UK resident, you could be a foreign national, as it's called. So there is no restrictions. One of the unique things about our tax system, it has a lot of disappointing things, but one of the good things is it's really flexible about who can have a SSAS pension. So as long as you are the director of a UK company that is registered on Companies House, and you pay some form of UK taxation, i.e. corporation tax or business rates, or some type of self-assessment, then you can have a SSAS pension. So there is no length of time. It's just basically you get in what you get out what you put in.
Cool. Another one here. What is the difference between a SIP and a SSAS?
So there's a couple of fundamental differences, but ultimately a SIP is an individual pension scheme, and a SSAS is a family pension scheme. A family wealth is for 11 members. One of the unique differences is your SSAS can lend money to your limited company, the loan back. A SIP cannot do that. And also, when you die, your SIP dies almost with you, but as you transition it to somebody else, where your SSAS continues to go and go. Because even though I said we call them a pension, the best name is a trust, and this trust, when it's been approved by the HMRC, is good for 125 years. So it's good for at least a couple of generations, and then some more after that probably. So yeah, that's the fundamental difference. Is that think of a SSAS as this family wealth vehicle with a lot more abilities, and a SSAS, because a SSAS is a non-regulated product, you also have a wider scope of investments that you can do, because it's a non-regulated product. You are the decision maker of where that money goes within the rules of HMRC. Within a SIP, you have restrictions put on by that SIP provider.
Brilliant. So next question here is, can the SSAS invest with other investors using cash or SSAS in a joint venture to acquire commercial property? If so, how would that work in practice?
Yeah, so the simple answer is yes, it can. So let's just say your SSAS could invest into a joint venture with another SSAS, with another non-SSAS loan. You could do a pooled investment to buy an asset. Let's just say, for simple figures, there's 3 people or 3 individuals invest into a property or an investment or a commercial property. Each SSAS puts in, each one SSAS puts £100,000 in, and the other 2 investors put another £100,000 each in. So you all own a third of that property. The deal could be structured in such a way that that there's like an SPV sort of created for it, and of that each earning a third of the rent goes to one company, a third to another, and a third goes to your SaaS. There's all different ways you can structure it. What I'd always say is the best type of machine is the one with the fewest moving parts. So if you're going to do that, just think of the most simplest way to structure it. And our job at Empowered is, like I said before, always start with the end in mind. What do you want to do and why? And how can we structure it? What's the best way of doing it? I always have this general thought as well in SaaS or in business in general. Just because you can doesn't mean you should. So just because you can do something that way is the more simple way to do it to get to where you want to be. But pooling funds together is quite a normal activity, and we help our clients do that.
Thanks, Gareth. Apologies if this question has been answered before. I joined late. Can the SSAS pension be accessed early if I decide to retire early?
So right now, retiring early is 55, and and that's soon to go up to 57. Now, technically, you can get access to your funds before before that age, if it's a medical issue. Well, let's just say you've been um, given so many months to live, etc., things like that. But it's actually very difficult the process to go through because we've got to be able to prove to HMRC that there's a reason for that taking place. So, as it stands right now, once you get to 55, or for most of us 57, then you can start to draw down and take them funds in retirement. Your pension changes slightly when you start to draw down on it. But again, if I look at the question a slightly different way, going back to one of the unique features of having a loan back is you can take money from your pension today, give it to your limited company to, let's just say, do residential flips or buy property or create a portfolio that could create you that income today outside of your SaaS, using your SaaS as that investment bank to create money. So you can create cash with your SaaS pension today outside of your SaaS using that structure. So yeah, you can retire early, but maybe one of the goals would be is how could you use them funds today to give you what we call day one cash today.
Fantastic. Brilliant. Next question here. Can you tell us a bit more about Fabric? What areas do you cover? What are your fees? Is it a membership subscription to see opportunities? Okay, so guess this one's for me. Yes, Fabric, we cover pretty much all of the UK. I'd say majority of our deals are based in the north because most of our clients are looking for yield opportunities, in good value for money. Doesn't mean to say we don't do deals in the south, but we mainly do stuff in the north. In terms of our fees are more often than not, I'd say 95% covered within the purchase price. That's one of our big USPs. We don't charge you a buyer's or acquisition fee. And also on top of that, there is no subscription to see our deals. So in a second, I'm going to give you an opportunity to, if you want to see the deals, to write into the chat. So actually, I'll tell you what now, if you want to see the deals or more information, the data room and all of the deals that I showed earlier, if you just want to pop the word deals into the chat, that will give us, to take a note of who wants to see those, and we'll get those out to you. No problem at all. So hopefully that answers your question there. But it's really, we've been operating since 2014. So we've been in the market some time. We've done everything from small deals, 2-bed, 2-up, 2-downs, HMOs, commercial, like we showed here, that's relevant for your SaaS. We also have a division in new build, and then the larger division is the asset management team. So we cover for all levels of investor, but hopefully that gives you a brief. And I'll also, anyone who puts the deals in the chat, I'll send you our brochure as well, so you've got a bit of a background about us. Cool. Next one. Thanks, Matt and Gareth. Great webinar. Can a SaaS be used to invest in both UK and overseas property?
So, interesting question. So, UK property, yes, it's not a problem. That's what a SaaS pension deals with on a regular basis. Very easy to deal with. So yeah, that's not a problem. Overseas property, slightly different, and it maybe has to be done in a different way. So, as I called it before, your SaaS is a trust and is recognised by UK trust law. Other countries don't always recognise trust law in the same way, and so it can be sometimes more complicated. We've done it in the past, and it's very difficult to manage it through because of the different legal systems that exist. But you could do a loan back from your SaaS to your limited company and buy the property that way and repay it back. So there's different ways you can do it. Definitely easy. UK property, it's bread and butter stuff that happens all the time. Overseas property, there's different ways to how you could address it. But again, part of our role at Empowered is we help you set up your SaaS. We do work with you to understand what your goals are. And if that was one of your goals, we would work through what was the achievable, how could we do it, what are the opportunities to get there.
Brilliant. Thank you. I've got another one here. It says, Matt, does Fabrics have smaller deals that are compliant with a SSAS pension? So yes, is the short answer to that. I'd say the smallest deals we work with are about £50,000, all the way up to £1 million plus, and everything in between. So just because I showed you the deals I showed you tonight doesn't mean that we can't source others. We are very much tailored to the investors that we're working with directly. So, if we've got a specific budget we're working with, we'll be able to go to market and find that for you. So hopefully that answered that one. I think we've covered everything there. One more, I think I missed this one. Can I choose to pay in SSAS instead of employer's chosen pension provider? Would the employer agree to, or do I have a choice?
Good question. So, a couple of different ways to look at it. So, your employer could decide to pay into your SSAS, and they could decide not to as well. That's their prerogative. You need to look at it from a tax point of view. If you're paying into your company pension, that means you're getting the 20% tax rebate through your wages. You can get that through a SSAS, but you have to do a self-assessment to reclaim it back. Or you could do both. We have some clients where their employees do pay into it. We have one client that sticks in my mind where the employee pays into their company pension and pays some into their SSAS pension. But I would say have that chat with your employer first about what they allow and what they will not allow. But again, it's pretty flexible. You can decide to do different things really. So it all really depends on what your company allows and what's best for you from a tax position and where you are. So talk to your accountant as well. We can't give tax advice, so always have a chat with your accountant about what works best for you.
Brilliant. Perfect. Well, I think that is everyone's questions there. I see his last one here. Really interesting and informative. Thank you, Gareth and Matt. I'd like to speak to you both this week. So on that subject, if anyone would like to have a one-on-one with Gareth, please just type the word Gareth. If anyone would like to have a one-on-one with myself, please type the word Matt. And if you missed the sort of QR code that Gareth put up earlier, just type the word SSAS, and then we'll make sure all of those documents are got to you.